All right, welcome back. We're going to be getting into Chapter C3, which is the corporate income tax. And it gets calculated differently than it does for individuals, which is C. If we can get into that. Here, we've got Chapter 3, corporate income tax, learning objectives, to select tax years and accounting methods for C corps, calculate deductions particular to corporations and arrive at corporate tax liability, recognize what a control group is and determine the tax consequences of being a control group, identify planning strategies to reduce tax corporations and their shareholders, comply with corporate tax filing requirements, and finally determine the financial statement implications of corporate federal income taxes. That is getting into ASC 740. We'll get into that. I've got an example of one that I do for a client, which I'll show you. But getting into it, corporate tax year can use calendar or fiscal year. So unlike S corporations or proprietorships, you can use a fiscal year end. So the tax year must equal the financial accounting year. Tax has to agree with the book in terms of the closing date. Tax year must always end on the last day of the month. So you can't say July 15th is my closing date. It has to be July 31st. And a short tax year corporation begins or ends business in the middle of the year. When you start a new corporation, you're going to have a short tax year, unless you started on 1/1 of whatever tax year you're on, or a month beginning. So moving on to corporate tax year, must request change in accounting period by filing Form 1128, unless the IRS procedures permit an automatic change. We'll have a short period between end of old period and start of new, right? So if you change it, your tax year, you're going to have that timing difference, and you have to file a separate return for that timing difference. Form 1128 is due by the due date of the short period return, including extensions, and the change must not create a substantial distortion of income. They don't want people changing tax years for tax evasion, right? If this creates a substantial distortion where income expenses aren't really calculated in the way that's fair or by the IRS correctly, they're probably going to disallow the change. So general rules for determining corporate tax liability. This should look fairly familiar to you because it's pretty similar to individuals, but there is some change there. So we've got our gross income less our Section 162 deductions and losses. That gets us to our taxable income before special deduction. So you take those out, you've got your taxable income, multiply that by your 21%. So that's your corporate tax rate. Then we've got applicable tax credits we could apply, right? There's some business tax credits. Plus, we would add back personal holding company tax, accumulated earnings tax, and other special taxes to get to our total tax liability. And then you take out estimated payments that you, and that gets you to your net tax due order. So in a C corporation, sales of exchanges of property, so net capital gains. So you net it similar to an individual. Any net long-term capital gains greater than short-term capital gains get netted. If there's a net capital loss, you don't deduct that. You can carry it back 3 years to offset capital gains and then carry it forward 5. Also with C Corps, there is no preferential long-term capital gain rate. That gets counted as ordinary income and gets taxed at the 21%. Capital loss carryback and carry forward is treated as a short-term capital loss. And Section 291 recapture rules may cause some or all of the gain to be ordinary. For example, your Section 1250. So getting into C Corp business expenses. So we've got Section 162, which hopefully you're fairly familiar with, allows for ordinary and necessary expenses. We've got Section 195 startup expenses. Those get capitalized and amortized over 180 months. We covered that in the depreciation chapter, I believe. Organizational expenditures generally must be capitalized and amortized, and accrued compensation has a 2.5 month rule. So you can accrue it as of the corporate year end, but you got to pay it out within 2.5 months. And I'll give you a good example of this. Something I just had to do this week. Accrued a bonus for shop employees for a client, and their fiscal year end is 9/30. So I had to send out an email saying, hey, just so you know, by 12/15, 2.5 months after, this has to be paid out. So we can't accrue it and then wait longer than 2.5 months. So because their year end is September, we've got October, November, and then half of December, so December 15th. That's when that bonus has to be paid out. Executive compensation, it's limited to 1 million per certain covered executives and entertainment expenses, starting with the Tax Cuts and Job Act, generally not deductible. Limited exceptions exist, but generally, if you see entertainment expenses, it's not deductible. We've got interest expense, it's deductible, but there are certain limitations applied to it. Limited to the sum of your business interest income, 30% of your adjusted taxable income, or a floor plan financing interest for motor vehicles. Disallowed amounts carry over. It's just if you meet one of these factors, you're going to be limited on how much interest expense. Charitable contributions, so we've got section 170, a deduction allowed for contribution made to a charity or a state or local government or political subject. You got to have a charitable intent to make the contribution, and it's only when it's paid. You can't accrue it and then claim that deduction for a charitable contribution. This gets treated a little bit differently, I mean, because I know that we just covered that, hey, you can accrue expenses or accrue compensation. But for charitable reasons, you got to pay them. You can't just say, I'm going to do it and then take the deduction. You actually have to. You can deduct it if it's accrued. Let's get rid of something. The board authorizes the contribution that the taxpayer pays within 3.5 months of the year end, or 2.5 months for 6/30. So certain limitations still apply. But generally, you can't just say, yep, I'm going to give $100,000 to Goodwill and then claim that deduction. Your board has to authorize it, and generally, to get around it, you just got to pay it out. You can't just state your intention to do it. So contributions of property, general rule, your deduction is equal to the fair market value. So this is some asset that I have that I'm donating. It would be fair market value. Exceptions apply if it's ordinary income property or if it's a capital gain property. Ordinary income property is inventory, investment property held for less than 1 year, and property with depreciation recapture. In that case, your deduction would be your fair market value less your gain or ordinary income. And again, this is contributing property to a charitable organization. You can donate inventory, but there's also some calculations that get involved with that. Taxpayers can deduct the cost of inventory plus a 1/2 markup for inventory donations, as long as the donation is used for the care of the ill, needy, or infants. It's not transferred to a charity in exchange for money, property, or services, and a donor receives the statement from the charity saying, this is what you do. Calculation for contributions of capital gain properties. So property that has a built-in gain, but it's not subject to depreciation recapture, then your deduction is the fair market value of the property. Exceptions exist. The charity does not use the donated tangible personal property in a way that is related to their tax exempt purpose. So they have to, generally how it is that you donate this property, you receive a letter saying, yep, we are using it for its intended purpose. It can't be used for something else, and you get a deduction for it. The charity also has to hold up their end of the deal and use it in a way that is related to their tax exempt purpose. So here we've got an example. So taxpayer contributes a forklift to the Salvation Army for use in their warehouse. The forklift has an original cost of 10,000 and 4,000 depreciation has been taken. The fair market value of the equipment is 9,000. So if we were looking at this, it's got a built-in gain. The deduction would be the fair market value of the equipment. So 9,000. So donation of inventory example. Taxpayer is a retailer and donates 1,000 blankets to the Red Cross for use in the disaster area. The blankets retail for $20 each, but have a cost of $5 each. What is the amount of charitable deduction? Here we go back to inventory. So they would have the 5,000, right? Back here. So it would be 5 times 1,000 plus 1/2 of the one. So you got 5,000, 1/2 of 20 is 10, that's 1,000 plus or 5,000. So the deduction would be 15,000. It's the cost plus 1/2 of the markup. Markup is 20, and that's 1,000. So example, donation of capital gain property. ABC Corporation has a tract of land that it acquired many years ago with the intention of building a warehouse on it. Now the taxpayer has no use for the land in the near future. ABC contributes the land to the YMCA for the site of the location. The original cost of the land was 50,000. Its fair market value is 1.5. What is the deduction? Well, if we go back to our capital gain, property that has a built-in gain but is not subject to depreciation and capture, deduction is the fair market value of the property. This we would say 125. So limitations on deductions. So maximum total deduction permitted in any given year is 10% of the adjusted taxable income. Your ATI is taxable income without the effects of charitable contribution deduction, capital loss carryback, or your dividends deduction. We will get into the DOD over the fifth year, but note that your adjusted taxable income does not include any NOL carry forwards. So it's just kind of specific to that year. So the taxpayer can deduct up to 10% of the adjusted taxable income. That limit is increased to 25% for cash contributions for 2020 and 21. Contributions greater than 10% can be carried forward to the next 5 years. So you don't get it this year, but it's carried forward 5 years. If carried forward is not used up at the end of the 5 years, it expires and is permanently non-deductible. So it's really important to use that within the 5 years. And you must first deduct current year contributions, and then you can factor in your carryovers. I'm going to stop this video here, and we will get into the special deductions in our next video.